Hey guys, this is Jonathan, just checking up and talking about stocks today. So the whole point of stocks is to kind of increase your income somehow, right? So the best way really with stocks is to make sure that you have a good trading organization. So I started off with E-Trade. Now E-Trade's pretty good except for their fees. Their fees are kind of pretty high actually. So the whole point of stocks though is to think about your moves and see where your money's going to be spent. Realistically, because the whole point is for you to make a profit. Now if you're doing too many fees, too many transactions, that's going to cut into your profits. Now there's different ways you can create profit in a stock. So there's the dividend technique, which is where you buy a stock with high dividend percentages, and so on the stock it'll say a dividend yield of blah blah blah, and usually they give it out every quarter, and you have to be there before that quarter started to receive that dividend. So that would be a long-term investment, and most dividend stocks are good stocks because they are for larger corporations and businesses, and they're trying to keep their shareholders happy. Now realistically, unless you own a whole lot of stock, you're not going to make your money back in on probably about 10 years. So it's going to take you 10 years to receive that money back. Now that might not be the smartest idea for someone who's not making that much money, but then if you really would like to do a flip, right? If you want to flip your money, the tax percentage on that depends on your regular tax income. If you hold a stock for less than a year, then when you have to tax it, then it's based on your tax income. But if you hold it on for more than a year, it actually goes down to about 15% tax margin, which is lower than most tax. Now that's about the same percent tax for me, just because I don't have kids or any realistic responsibilities. And so for that, if you're trying to do quick flips, you need to make sure that you know how much money you're going to spend in the end, because you need to factor that 15% tax margin in. And so, or whatever your tax margin is, mine is 15. And so once you do that, then you can really see where your profit's going to be. Now, realistically, you need to look at something that's a bigger corporation. Now, the first stock I did was a penny stock. It's called Freedom Leaf. And I think it's still around. It's based in Nevada, I think. It was basically a penny stock, right? So it was worth probably less than a quarter when I bought it, or what is a dime? Yeah, around a dime. And then I sold it off for I don't remember, it was like 12 cents instead, but I had 400 shares of it, so I made a little bit. And honestly, if I would have waited, I would have, rather than making about a $40 profit, I would have made a $1,000 profit. So again, you need to be careful where you're spending your money. It's money that you can't say, oh, I need to cut my loose ends. You put this money in there for a reason, because you're trying to gain a lot or a little bit. So you need to detach your emotional and your financial sense away from it and think about it, rather than money that you currently have. Think about it as a logical decision. So once you do that, then you can actually pull your money out at a good time. Now, that's a quick flip. Now, most financial advisors, they're going to tell you that you don't want to do a quick flip. And the reason for that is it's gambling to an extent, because a quick flip is made for you to go in there, get out. And so with that comes the risk of it not being a good enough stock. The real maturity of a stock is about 8 years. So from there, within 8 years, you're going to know if it's a good stock that's going to do well or not. And that's probably how each stock is, and so 50% of the stocks after 8 years will not be around. So realistically, that's a lifetime of a stock. So you want to hold it on for a little while. Once you make your profit, sell it off. Now you can integrate dividends into that idea, which that's probably one of the smartest long-term decisions to make, because when you put it as a dividend, then you're making an annual or quarterly income, right? And then also when you decide to sell it off, then you also have that money that you just made a profit out of. Now make it's all based off of your decision. If you think it's the correct time to pull out and you think that's where you're going to make your most money, then do it. But remember, it's already money that you spent thinking that you weren't going to get it back. That's the whole point of stock. So when it goes down, do not pull it out. That's what everybody else does. That's what's going to defer you. You put your money in when it goes down and you take your money out when it goes up. You need to find that spot where it pinnacles. Now you need to learn how to read a chart, and it'll go up and down and up and down, and you need to do research on that, because without research you're not going to know enough about the stock to make a good logical decision off whether you should buy it or not. So in all, buy a stock that you know first. Make sure you know the company, do all the research, and if you really want to go into it super deep, and you should for the most part, then I would suggest looking at all their data, because they're required by law. The second that they become a public company, they're required by law to show you all their information, because you're a shareholder. You are now owning a piece of that company, so you can look at their financial statements, their earnings, their costs, whether they've converted any profit realistically, where is all their money going towards, all of those things. You can see that now because you own a piece of it. So remember that. Look at that information before you decide to buy a stock. Honestly, I want to buy a few more stocks, and so I will soon. But it's a good thing to, hey, put a $50 here every paycheck. $50, and don't put $50 on a stock for the most part, because your fees are going to outweigh the realistic profit that you're going to make. Wait $100 to $200 before you actually stick it into a stock. So just put $50 aside for a week or two paychecks. Then from there, then you can actually invest it. It's important that you do it that way, so that you don't end up losing your money on the high end or the high rates that you're going to get. So I would recommend probably E-Trade for a beginner, as long as you understand that you can't be trading constantly. If you have Chase already, I do. So I would suggest maybe looking and seeing if JP Morgan has a good one. I think it's a $3.99 trade. You could try that. There's Robinhood. Now, you have to be 18 to do Robinhood, E-Trade, and I believe JP Morgan, you can actually do it as a custodial account, which is actually what I have. And doing a custodian account means that your parents on it, but you are in control of it, so that this way, it requires both your social security cards, but they're linked together so that you have like a reasonable source of income and all those things. But it's really not something that you should worry about if you don't have. But try to get it. It'll help you in the long run. Investment is important just so that you have a passive income, and I'll go into a passive income later. Thank you. You have a great day.